This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Welcome to Bloomberg Businessweek Daily. Carol Massar, Tim Stenovec, live here at Bloomberg headquarters. And I ask, what rally?
Yeah, well, there was a rally earlier today. Nvidia was up as much as 5% earlier in the session. We saw the major indexes in the green, Carol. Now, it's not the same story.
Yeah, if you blinked kind of mid-morning, you missed the gains that we saw earlier. Same story for, as you said, Nvidia. So we're on the markets, no doubt about it. Also this hour, we did finally get a monthly jobs report for September. We're going to get into the U.S. economy with Mike McKee. He's settling in here right in our studio.
Well, on that Nvidia story, it rallied, then it dropped back. Why the chip giant needs investors to party like it's not 1999.
All right, going to get into that. Also, is Blue Owl the canary in the coal mine? Just a question, folks. We're not pointing fingers or anything, but we're trying to understand what's going on in private credit. We'll get to that over the next 60 minutes. First up, let's get to that selling on Wall Street. Here is Charlie Pellet.
All right, I thank you very much. Happy Thursday to you both. Not such a happy day for the bulls with the Dow, the S&P, NASDAQ, all retreating right now, running the GIP screen on today's S&P chart. We are just about the low of the day right now. Looking at a loss of 1.1% on the S&P, down 76 points to 65.65. The Dow Industrials down 350 now. That is a drop of 0.7%. NASDAQ down 352, drop there of 1.6%. NASDAQ 100 index down 1.7%. Russell 2000 index of small cap shares down 1.1%. But a close eye on the Mag 7 index down 1.1%. Nvidia down today after an earlier pop. Tim mentioned up by roughly 5% in the early going. Nvidia right now down by 2.4%. So again, the S&P down 77, drop there of just about 1.2%. 10-year 4.09% with a 2-year 3.55%. Gold down $14 the ounce. Spot gold $4,062 right now, a drop of 0.4%. West Texas Intermediate crude down 0.5%, 59.12 a barrel, and Bitcoin now down by 4.6%. Bitcoin 86,314 on Bitcoin. We're keeping a close eye on that. Nvidia, though, the big equity market story today, it is down by 2.3%. We've got other big tech names tumbling as well. Google down by 0.2%. Alphabet, to put it correctly. Meta Platforms down 0.9%. Microsoft down 1.4%. CoreWeave now down by 2.2%. And around other cloud-related names, Oracle down by 4.8%. So recapping here, Nvidia down 2.2%, S&P low of the day down by 1.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, you're up to date on the market trade. Thank you so much, Charlie Pellet. We're also getting up to date, slowly but surely, on the U.S. economic picture, courtesy of U.S. economic data from the U.S. government. It has started to flow after the longest government shutdown in U.S. history. We did get the monthly jobs report for the month of September. Job growth topped expectations in September. Non-farm payrolls, Tim, rising about 119,000. The unemployment rate, though, continued to rise.
I want to bring in Mike McKee, he's Bloomberg Television, international economics and policy correspondent for Bloomberg Radio as well. Mike, is this information like, could have been useful 6 weeks ago? Do we get any, do we glean anything from something like this?
Not really. It's been described by one analyst as a sort of Rorschach test. You see in it what you want to see. Maybe some people see clouds or something like that. But those who think that the Fed should be on hold point to the strong job creation and the fact that inflation is still going up. And those who think the Fed should be cutting can point to the unemployment rate, although this unemployment rate rose because of a large jump in the number of people looking for work. The labor force rose significantly. So
can you explain that?
Good reason. Well, it's just it's math. It's the denominator is higher.
Well, I understand that, but why were more people looking for work? Why we
don't really know. There are some theories Steve Stanley at Santander is pointing out today that that they have had trouble in the summertime adjusting for all the college graduates who have not been able to find work coming out of college these days because companies aren't hiring. And so that seems to have caused a problem in measuring the number of people who are in the labor force. And that may be one reason. I don't have a good other reason, but there are a lot of people coming into the labor force according to these data.
We also got weekly jobless today, right?
We got weekly jobless, and at 220,000, it's pretty much where it was when we last left you back at the 1st of October. So the story is still the same: low hire, low fire.
Low hire, low fire. It's interesting because we keep trying to figure out. We talked to everybody about kind of where we are in the U.S. economy, and it seems like not too bad, but there are still inflationary worries, and it does feel like the job market's softening. I want to layer something on top of that, and this is from Fed Governor Lisa Cook, who she said officials should monitor how unexpected losses in private credit may spread to the broader U.S. financial system due to the, quote, increased complexity and the interconnections, end quote, with leveraged firms. It's something we've been focusing on a lot here, and I know all of Bloomberg has been. We're going to talk about Blue Owl in just a moment, which is among our most read stories. But how are you were here during the financial crisis, and I don't want to say that the sky is falling, but what are the things that you watch to get an idea if there is stress in the financial system that might portend some problems?
Well, I think the important thing about the financial crises is that they're never the same. We have one. Regulators patch the holes, and then we have a different kind. And now we're looking at private credit, which has grown tremendously. And it has also grown in the area where regulators don't have a good idea of what's going on. And that's what they're afraid of here, is the interconnections that might be among these lenders. The lenders say, we do extra due diligence because we're private, and we have to make sure that we're not going to lose money, so we make sure that the borrowers are okay. But we've seen some of these not work out. And so do they have it? Does that mean if you're not getting paid for one, okay, you're going to maybe make payments on the other, which is always the real start of these problems, is contagion. So you're looking at defaults and the default rate, and you're looking at the rate of fallen angels. Now, all these private lending are in most cases to private companies, so you're not going to get a complete picture, but you get some idea of what's happening out there in the credit world. And then you can watch some of the interest rates that, what are people charging for subprime loans, and how does that maybe translate into a private equity.
One thing I just want to ask you quickly, though, when a Fed governor starts to talk about this, I mean, I know this is what they're supposed to do, right? They're in touch with certainly the financial community. But I mean, I don't know. Should we read anything into it?
I think there's a rising concern because of the overall state of the economy, but the Fed doesn't have a lot they can do about it because they don't have supervisory ability for this situation. So that maybe raising the issue is the best they can do to try to get people's attention on this.
Hey, Mike, one thing that got my attention yesterday, and you were in Washington, D.C. for the Fed minutes, so we didn't have a chance to talk to you about this, but just about 24 hours ago, the president made some comments to the U.S. and Saudi investment community, and he made this joke that he'd fire Treasury Secretary Scott Bessent if interest rates don't get lowered. We know that the Treasury Secretary does not have direct control over interest rates, but we also know that he's leading the effort to select the next chair of the Federal Reserve when Powell's term is up in May of next year. I thought that was like a different tone coming from the president, and it showed that, and there were a lot of comments too about the Fed chair in the last 48 hours that didn't get as much attention as they've gotten in the past. But I'm curious how you look at comments such as those and whether or not Scott Bessent is actually going to have an influence on rates because of the selection for the next Fed chair.
Well, it's a sort of a second level impact if he picks somebody that would then lead the Fed to cut rates more, then yes, you could say he would have an impact. He's not going to have any impact on Jay Powell and the current makeup of the Fed. But the question is, who does he recommend to the president? Who's the president going to pick? And one has to assume that, given all the comments he's made, that Trump is going to sit his nominee down and say, look, I expect you to cut rates. Now, who can say no to the president? I mean, that's going to be the key question. And that's going to be the question that all Wall Street is going to ask when whomever it is appointed. Is this guy going to stand up and do what's right, or is he going to do what Donald Trump wants?
Well, right, there's the predicament of saying no to the president, but also saying yes, cut rates. And then you're answering like yes to the financial markets, who might be like, wait a minute, are you just doing this under duress and doing this under pressure from the president? And then it's not an independent Fed, and then you see potentially
that's the question,
market instability.
Will people be upset by the idea of an independent Fed? Now, markets have turned around today, but this morning we saw them go up on the jobs news because people thought that meant that the Fed might cut rates, the unemployment rate going up. And that, when Fed cuts rates, stock market is happy. But in this case, it'd be a step beyond, and they'll have to raise the question of, okay, now are they going to cut rates and bring about inflation, which we don't like?
See, it never gets boring.
Who was it? Stuart Paul yesterday talking to us about the measure that Bloomberg Economics has about the Fed independence and a lack of, or not so much, a lack of political persuasion over the Fed.
Yeah.
Yeah,
right?
the administration at this point doesn't have any. You see Stephen Myron flailing about, saying the same things over and over again about we should be cutting rates 50 basis points and giving economic arguments that Wall Street just rejects. And the rest of them are, right now, the majority of the people who've spoken out have said they want to leave rates where they are.
It's still a vote, ultimately, right?
It's a vote, and it's 12 people out of 19, and so one person isn't going to necessarily make a difference.
All right, good stuff. Mike, thank you so much.
Welcome back, Mike.
Yeah.
It's lovely to be back.
We're going to talk about his travels in the weeks to come. He's been doing some cool things on assignment.
It was for work. It wasn't vacation. I want to clarify to everybody.
It was for work.
It was for work.
Working my fingers to the bone.
Yeah, it's good for you. Bloomberg TV international economics and policy correspondent Mike McKee. Hey, quick check on the trade, if we may, because we have seen markets. We were down as much as 2% on the NASDAQ 100. We bounced off that low. Still a decline of about 1.8%. The S&P 500 down 1.1%. And if we take a look at Nvidia, we're looking at that stock. It is down. Let me just pull it up here. It is down, Tim, about 2.4%. We've been down just shy of 3% at its lows. Also at its highs, we've been up as much as 5%.
Well, after the close Wednesday, Nvidia delivered a surprisingly strong forecast and pushed back on the idea that the AI industry is in a bubble, easing concerns that had spread across the tech sector. The world's most valuable company expects sales now of about $65 billion in the January quarter. That's roughly $3 billion more than analysts predicted, Carol. Nvidia also said that a $500 billion revenue bonanza due in coming quarters could be even bigger than anticipated.
Yeah, there's been a lot of talk of an AI bubble, and the CEO, Jensen Huang, said on a conference call with analysts that from his vantage point, we see something very different. We highly recommend you check out our Ed Ludlow's exclusive interview with Jensen Huang. You can find it on the Bloomberg and at Bloomberg.com. Right now, we want to bring in our Bloomberg Opinion U.S. technology columnist, Dave Lee. He's got a couple columns on the terminal, but one that caught our attention, that the chip giant, meaning Nvidia, needs investors to party like it's not 1999. He put this column out ahead of earnings. Good to have you here with us, Dave. What do you mean by this?
Well, look, the question is no longer, is this an AI bubble, right? I think we've all come to the agreement there is a bubble of some kind, but is it going to be a bubble like the internet.com bubble where there was just devastation when many of these companies that had, suspect balance sheets turned out to be suspect companies? Jensen Huang, he is saying, look, there's huge hype, there's huge excitement. There's a lot of questions about how companies are going to use AI, but from where he's sitting, as you were just saying, they're still seeing this incredibly strong demand for what they do, which is obviously create the world's best semiconductors
to be
for
fair,
AI.
He's got a fiduciary responsibility. He's not going to say, right? Like, he's got to be careful in terms of how he quantifies or qualifies his business. And the numbers, many would say, yeah, there is still strong demand.
Still strong demand. I think that it was interesting to see the reaction to the earnings last night, because the immediate reaction was, wow, this really pushes back on the idea there's a bubble. Today we're seeing a retraction of that somewhat, right? We're seeing traders sort of say, well, the problems we were still worried about before the earnings, they still exist despite the earnings being so strong.
What I found so interesting about that is that we did see highs of close to 5% in the morning, and then starting at about 10 o'clock, shares started to fall, ultimately now down 2.7% for Nvidia. What is your take on why the collective market sort of recognized something here? There's no catalyst, at least to my knowledge, that no new information came to light that would send shares lower.
Well, look, one of the defining parts of this new bubble so far has been, whenever there's a slight clue as to the future AI, the reaction needs to be overstated. So you remember that afternoon or that morning when DeepSeek was released, the reaction to that
day back in January.
I mean, just devastating, right? Everyone was sort of panicking, and then when people really thought about it, they thought, well, you know what, maybe this isn't so bad after all. The same is being, I think, could be said for sort of positive moves. And look, nobody was coming into Nvidia's earnings yesterday thinking, oh, this could be, these could be bad, or everyone was expecting it to be a great quarter. Now, it's stronger than some people had thought, obviously, based on the analyst estimates beforehand. But the dynamic that people are worried about isn't so much how Nvidia is doing, but how are their clients doing? When they buy all this computing power, is it going to be worth it for them? And that's where the
ROI ultimately.
The ROI, yes.
What?
Profit margin. I mean, whenever we talk about bubbles in the 1999 and late 90s, early 2000, what people come on who were there tell us, and their pushback is, yes, but these companies are now profitable. I mean, Nvidia sees fourth quarter adjusted gross margin of 75%. Like, we're not talking apples and oranges here. Like, this is a completely different type of company than we saw supported in the late 90s. I
think, no one's, and I said this in my column, no one's calling Nvidia the next pets.com, right? or the risk of that. But Nvidia's clients could be the next pets.com. OpenAI, there's a company burning billions of dollars with an unsure way of getting that money back. CoreWeave was a catalyst for a lot of the worries around, just data centers in general. They're still finding it very hard to build data centers. It's going to be a big problem finding the place to build them, finding the energy to power them. There's a lot of unknowns that could be at play here. And when we compare it to that dot-com bubble, I have to say I wasn't covering it because I was a child.
However, you and me both.
All right, I was covering it. And I will say there is a difference, and we talk about this, that there are companies with earnings, but it's so I'm trying to understand, the demand is there, and you're saying, we get it. They can't build the data centers fast enough. They don't have the energy to power them. Is that enough to mean that this is not a real thing and that AI is not going to impact us and the spend continues in terms of the build out? Is it just case that we have the timeline wrong?
The timeline is the question, right? Because when we look back at the dot-com bubble, people say, and again, this is in the column, they say, well, what about Amazon, right? There's a real company, changed the world.
Not profitable, not profitable, not profitable.
Exactly, for years and years and years. And it didn't recover from its dot-com slump for another 8 years after 1999, 8 years. I noted that Cisco, 25 years, it only recovered from the dot-com crash this week. And so sure, AI could be as big as the internet, or even electricity, as some people are saying. Whether or not there'll be a slump in the meantime that could take a huge amount of time to really recover, I think that might be one of the concerns that people should be having.
So the debate continues.
Patience, I think, is the key.
But okay, all right. Because it's like the back and forth, right? Like, we feel like in any given day, it's like, what is the right narrative? And at the same time, while there's concerns, we continue to see companies spending big time in it. And they're getting more and more interconnected. It's like a bad game of Twister. It's the AI version of Twister. Am I aging myself?
No, that makes sense.
That makes sense to me.
I'm just trying to visualize the companies.
Come on, work with me on this.
Get the graphics department on it.
We are. Dave Lee, thank you so much. Bloomberg Opinion, U.S. tech columnist. Coming up, one of the most read stories.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We got ourselves a stock market sell-off on this Thursday. A Jobs Friday. Losses for the Dow, the S&P, and NASDAQ. S&P right now down 63 points to 65.79. That is a drop now of 1%. You got to keep in mind that at one point the S&P had been higher by almost 2%. Dow Industrials down 203 now, down 0.4%. NASDAQ Composite Index down 326 points, a drop there of 1.4%, with the Bloomberg Mag 7 index down 1%. Nvidia, key part of that index, it is now dropping by 2.4%. Your 10-year 4.10%, with a 2-year right now at 3.55%. Gold up $2.50 the ounce, up by about 0.1% to 4,080. And West Texas Intermediate Crude WTI 59.17 a barrel, down 0.5. And Bitcoin now lower by 4.3%. Bitcoin selling off to 86,630. Verizon Communications this morning announced wide-ranging layoffs that will shrink the company by as much as 20% of its non-union workforce, a major step in a turnaround plan led by the new CEO, Dan Schulman. Verizon shares on a down day for the rest of the market. They're up a little, changed up 0.1%. T-Mobile down 0.3%. Rival AT&T up by 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So once again, this week, a story around Blue Owl Capital is among the most read on the Bloomberg terminal, has been all day. This is as the company's shares had fallen to the lowest level since 2023, with co-founder Craig Packer blaming, quote, negative articles about private credit for the decline. Now, the latest stress point, I got to say, we talked about yesterday. If you might recall, Blue Owl Capital scrapped a planned merger of two of its private credit funds after scrutiny rose over potential losses for some investors. So the story's still a live one, and we wanted to dig a little bit deeper.
To do that, we're joined by Bloomberg News Chief Wall Street correspondent Sri Natarajan. He's here in the studio, along with Davide Scigliuzzo, Bloomberg News Chief correspondent for private capital. Both join us here in the Bloomberg Businessweek studio.
All right, welcome, welcome. Sri, I do want to start with you. You reminded us yesterday, Blue Owl, this is a firm that has been held up as kind of a poster child when it comes to the world of private credit. Is it, again, I want to ask you, the merger coming undone or something more? Like, is it just a company-specific thing that's a problem, or might it be the canary or owl in the coal mine? Like, is it something more in terms of what's going on in the private credit world?
Look, Blue Owls are supposed to be fictional characters in the real world, and it's now up to the Blue Owl management to prove that their marks are not illusory. In a credit market where you're dealing with private loans, the investors, your investors, are reliant on what you believe those loans are worth. Unfortunately for Blue Owl, many of their investors in their publicly traded BDCs don't quite believe the book value, and that's why it's trading at a big discount to book value. If you want to blame negative articles, that does sound a touch defensive and it's not going to really help the cause. And there are a lot of Wall Street veterans who are pointing in this direction and talking about trouble. But I would like to take a step back and say, you know, when you ask about whether this is a canary in the coal mine, we haven't seen some crazy implosion. When you're investing in 100 companies, there will be some defaults along the way. Right. The question is, can you keep it below what your peers are experiencing, and is it below your historical averages? So that tells you where you are in the credit cycle. And on those metrics, Blue Owl and the rest of their peers are seemingly doing just fine. But the mind goes back to the kerfuffle last month when Jamie Dimon got on the earnings call and gave what sounded like sage advice about the credit cycle and said, you know, when there is a problem somewhere, you can expect a few other problems to crop up, a few other cockroaches. For some reason, a lot of players in the private credit market took it as a direct insult hurled in their direction and got worked up about it. Prominent in that was Mark Lipschultz of Blue Owl, who really took a real swing at Jamie Dimon. A month later, you kind of feel like saying, if you come at the king, better not miss.
Well, before, I want to bring in Davide, but Jamie Dimon, how many times have we had conversations with you? We all wait to see what he has to say about any situation. He doesn't, or does he, just drop something to stir the pot? Does he do that?
Let me tackle this carefully. I think the fact that Jamie Dimon has been the CEO of JP Morgan, the largest bank in the United States with a $4.6 trillion balance sheet for 20 years now, right? Like it makes you think that he's coming from a vantage point that is unparalleled, to be honest. And he's got the experience and the position and the pedigree to speak his mind, and thankfully he does. In this case, and if you look back over the years, some of the things that Jamie has said, whether it's about work from home or a myriad number of topics, can veer towards the extreme. But what he said here seemed fairly innocuous. All he said was, there's never just one cockroach. There will be other troubles that crop up. He didn't necessarily say the others will be in deep distress. Why did the private credit industry take it so personally?
Yeah.
So Davide Scigliuzzo, come on in here, because you cover private capital for Bloomberg News. The focus that we've had this week has certainly been on Blue Owl, not just investor reaction, but also the press that we've seen around the company. Is this something you're seeing in your world outside of Blue Owl right now too?
Yeah, and I would say one thing to Jamie Dimon's comments, like, he wasn't wrong, because we have seen more of these situations, and across the industry. By the way, we've seen them on the bank side too. So I think there is a broader issue kind of in credit markets where people are questioning like some of the underwriting standards and red flags that may have been ignored in the past, and that cuts both ways. I think what Blue Owl really put on the map is an issue that all of these firms are kind of wrestling with, which is how do you sell this asset class to retail investors, and what is the right format to do that? You can, historically, they've done permanent vehicles, like very long dated stuff that it's great for institutions. You lock up your money for 7 years and it works well for them. But if you're making a push into individual investors, you have to provide some kind of liquidity. And what is emerging with this failed merger of Blue Owl is that liquidity is an in-between between daily liquidity and 7-year liquidity, and it doesn't kind of work as intended sometimes.
Well, how big of an issue is that for private credit overall if they don't have the market that includes retail investors?
I mean, I would say it's a big issue because a lot of funds are being set up in a similar way, where they provide quarterly redemptions subject to a cap. And you can either come out at NAV, which is basically the value of the assets in the fund that the manager assigns to them, or if it's in a public structure, you come out at the price that the market assigns to it. And the market right now is believing that most BDCs are 20 or 30% below their asset value.
But here's the thing. There was nothing crazy or revolutionary or wacky about Owl Rock or Blue Owl wanting to merge a private fund with a publicly listed BDC. It has been done in the past. The problem and the challenge was it was being considered, or at least it was presented to the market at a time when the amount of redemptions in that private fund were climbing. And if it climbs above a certain mark, Blue Owl might very well gate redemptions, and you never want to be in a position where you tell your investors you're not allowed to get your money back. They had been honoring all their redemption requests so far, but if you ever had to get to the position of gating redemptions, or basically saying, right now we will not allow you to pull all the money that you want to pull, that spurs panic. That results in more people wanting to run away from your vehicle. So instead, when they talk about wanting to merge it with this public vehicle, which is trading at a 20% discount to book value, which means once you're in there and then you want to get out, you have a 20% loss on day one, it starts to feel a bit icky. And that's what's really resulted in this market reaction that makes Blue Owl, or at least pushes Blue Owl into this defensive corner.
But all of this makes me feel like, okay, if Blue Owl is supposed to be the poster child, like if we're talking icky or redemptions or gating those redemptions, that to me, if you're talking about the poster child for private credit, then it makes me wait, like, okay, if they're supposed to be up here and they're maybe potentially having issues, what else is out there? Because not everybody's in the same situation.
And that
in other
goes
words,
back,
they're in weaker situations.
And that goes back to the broader concern about the industry. It's not just Blue Owl. I think Blue Owl is in the spotlight because they tried to do this at what some people, many people probably now would argue was terrible timing. But it is an issue that everyone in the industry has to kind of deal with.
I guess the crazy thing is, and we've had so many guests, I feel like you go to Milk in the last couple of years. First of all, everybody, all they want to talk about is private credit. And then it feels like the last year or two, it's more like, how do we get out of these deals? And like anybody who's got investments are thinking about their investors who after 3 to 5 years want to see some kind of returns, and they've struggled to get out of these investments. And I feel like they're just trying to figure out all these ways. And I just wonder at some point, do we have some kind of problems as a result? Or no, it's just, again, the timeline of how this has to come work out.
It's also the nature of credit markets, right? It's not equity investors. Credit investors generally tend to be a little more cautious because your upside is kind of capped.
Yeah.
You get principal back and interest on that, nothing else. Whereas if you're a stock investor, your stock could go today from $10 to $300 and then back to $150. You still would have made a lot of money.
Right.
Your 100 cents on the dollar will be 100 cents on the dollar when it comes back, or it goes down to 50, 30, or God forbid, 0. And that's why whenever there is a concern of, is the cycle turning? Is there a credit crunch coming? And when you have a space like the private credit space where funds that have been flush with cash, you see the enormous growth in that space in the last few years.
Crazy.
When they're all competing with each other to actually win deals, to put money to work, your automatic question is, did some people cut some corners, and so therefore when the cycle turns, could it be problematic? You talk about the potential issues with Blue Owl. We don't even see a ton of Blue Owl deals where there have been very obvious issues, but and Davide is too polite to point this out, but look at some of the coverage out of BlackRock and their credit investments. You've already had a trio of investment. They had, just last night we reported about how one of their private credit CLO had to waive management fees because they failed one of the critical tests on the CLO. There's a alleged fraud related to big telecom receivables. And then there was another deal that Davide wrote about just last week where the mark on that investment at one of the BlackRock funds went from 100 cents on the dollar to 0. 100 to 0 in a matter of weeks.
34 days.
Well, and as we're having this conversation, one thing I keep thinking of is this comes at a time when, over the last few years, we have had a lot of people in the private credit space and in the private investment space, Davide, say, these are the assets that we think Americans should actually have in their retirements. And I'm wondering if this exposes maybe a potential flaw to that strategy, this idea of marking it to market and having the traditional retail investor understand that this type of thing can be locked up for a long period of time.
They're just looking for a new line of demand.
A new place
so that
to
is
put
absolutely
the assets.
right. Like the new line of demand has been retail and insurance because the institutional market kind of tapped out. The second point I'd make is that it's very easy to sell private credit as a great opportunity when rates were rising and capital was available, and you had all of these dynamics where you could go to your investors and say, hey, you're investing in, senior loans that are at the top of the capital structure and getting, low double-digit returns with leverage, and that's great. Right now, we have rates coming down, and there is a question about, at least investors not being prepared for some disappointment when it comes to returns, but potentially credit issues when it comes to individual companies that just can't exist in that shape. And that's when you get the markdowns that we've been writing about.
Okay, so
to be continued.
Okay.
Can I just leave you with one thought? And
15 seconds.
I'll wrap it up in 15 seconds because there's been too much doomerism here. When David Solomon yesterday was asked about the concerns in the market, he said something. He quoted a friend and said, skeptics often sound smart, but optimists make a lot of money.
Nice final thought. Sri and Davide, thank you so much. We really appreciate it. This is Bloomberg.
We do check markets all day long here at Bloomberg. We have got the S&P 500 index close to session lows. 1 hour, 20 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ all declining right now. We did see a gain early on of 1.9% in the S&P, but that almost 2% gain has now vanished. Indeed, a loss of 1.1%, very close to session lows on the S&P, down 72 at 65.70. The Dow down 0.5%, lower by 243 points. We've got NASDAQ down 1.6% with the Mag 7 index down 1.1%. Nvidia, of course, big part of the story today. It is now down by 2.5%. The 10-year 4.10% with the 2-year 3.55%. Gold up $4.50 the ounce, up 0.1%, 4,083 on the precious metal. West Texas Intermediate crude 59.14 a barrel. WTI down by 0.5%. Bitcoin, what a story there. there. Bitcoin down 4.5%, 86,392 on Bitcoin. Walmart out with earnings. Walmart shares up 6.1%. Walmart also making another major announcement this morning. It is transferring its listing from the New York Stock Exchange to NASDAQ. That effective December 9th. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, Tim Stenovec, live here on Bloomberg Businessweek Daily. It is time for Bloomberg Businessweek's Women's Health segment. This is where we focus on key issues and developing technologies impacting the present and future of women's health around the world. And in many ways, we get into health generally. But with us right now is a special guest, Hugh. Herr. He's a professor from the MIT Media Lab, co-director of the K. Lisa Yang Center for Bionics at MIT. Dr. Herr joining us from Cambridge, Massachusetts. Hugh, great to have you here with us. Thank you so much.
Pleasure to be here.
Yeah, great to have you here. And if you may, your story, my understanding is you lost both your legs at 17. You're now helping others that have gone through similar things and helping them in their future. Could you just share a little bit about maybe what happened and really how it's shaped what you're doing today?
Yeah, sure. As a young man, I was passionate about mountain climbing. And when I was 17, I was in a mountain climbing accident and suffered frostbite. And my medical team gave up the fight to save my biological limbs, and they were amputated just below the knee. So today, I use very high-tech powered prostheses to stand, walk, and run. So from that experience, I really realized how limited current prosthetic technology was, and I really dedicated my life as a young man to really advance the field and enable extraordinary technology that will allow people to do what they want again, to move again.
Well, and if I
have the bodies that they seek.
Right. And my understanding, you've been at the MIT Media Lab for, I think, 21 years. You have a doctor of philosophy from Harvard. What has changed when it comes to prosthetics since you joined the lab?
Yeah, good question. When I was first fitted with prostheses when I was 17, the prostheses were made of wood and foam and metal. They didn't have any computational intelligence, no sensories, information, no actuation. And I said to myself at the time, really, this is it? This is what society can provide? Today, there exist computer-controlled prostheses that adapt and are even connected to the human nervous system, that can convey human agency and ownership and really restore physicality for humans.
So if that's what exists today, then what's coming in the next 10, 20 years? What are you working on?
Yeah, we are laser focused on integrating human biology with mechatronics. Our key goal is to connect the human brain to a built construct like an exoskeleton or a prosthesis. Our mission is to restore physicality. In the case of when a person loses a limb, or in a case where a person suffers a stroke and has paralysis, or has muscular weakness or joint damage, we can build these bionic systems to restore movement.
I am curious too, and we've been doing these segments for a while, and often we do any kind of medical segment, we do think about the differences between men and women. And I'm curious what you've come across when it's developing technologies or outcomes or prosthetics for men versus women. Are there differences?
Yeah, absolutely. In the case of limb amputation, amputations caused by traumatic injury are predominantly performed on men. In the U.S., it's about 70% men and 30% women. So because of that male dominance, the prosthetic technology seems to be developed through the lens of needs that men face and not women. So there's a tremendous need to develop truly personalized prosthetic limbs that reflect the needs of the individual and don't have that male bias. And that's a key area of research here at MIT.
Is that male bias because of war and military, or no?
I mean, it's typical for traumatic injury that there be a male dominance. I won't make a joke there, but whether it be spinal cord injury due to car crashes or amputation, there's typically more men than women. So the prosthetic industry needs to not only reflect the needs of men, but also obviously of women.
I have to say,
and that's a tremendous focus for our research.
No, I've got 4 brothers, 2 sisters, and my brothers, man, risk takers, and there were more accidents and runs to the emergency room. And
I didn't want to say that.
And broken limbs and things, unfortunately. So yeah, we definitely saw that.
100%.
So Hugh, I'm wondering about at what point, look, and it's a question that we have when it comes to any innovation, but we know that the work is always ongoing and the work will always continue, but what is the ultimate outcome, and when do you think we're going to be able to get there? You said the goal is to have this type of medical device be completely controlled by the human and as close to somebody's limb as actually possible. Can you give us a timeline when you will say we have achieved this?
Yeah, again, broadly, we're rebuilding limbs after amputation. We're also augmenting limbs that are fully flesh and bones. For in the case of a woman suffering a stroke, for example, we want to restore the functionality of her leg, as an example. Or a person that suffers osteoarthritis, we want to allow them to move again without pain. What's the broad goalpost? What's the broad goal? That that people don't experience unwanted limitation, unwanted disability. Imagine a world where when you lose a limb, or if you have a spinal cord injury, or suffered a stroke, or have joint disease, that you can move again. You can move without pain. You can dance again if you'd like. That's the world that we seek.
One thing I want to ask you, and certainly in terms of, I think about diabetes and how much that impacts our population, and that can lead to certainly difficulties or amputations, certainly with feet, toes, all that stuff that certainly impacts your mobility. GLP-1 drugs, is that something you think about, and how that might impact some of what you are doing in that regard?
I mean, any strategy that, in time mitigates the probability of an amputation being required from a severe diabetic state is, of course, fantastic. In many developed nations of the world, the cases of diabetes are increasing precipitously, and some of the cases are so severe that amputation results and prostheses are required. So yeah, we can approach the problem in 2 ways. A, preventing a severe state of diabetes. And in cases when there is an amputation that occurs, developing extraordinary bionics that enables a person to restore their movement capacity, their cardiovascular capacity, and maintain a high level of health.
Well, we so appreciate getting time with you. We want to talk to you about AI, but maybe we can get you back here and continue this conversation, because we know technology and medical devices and healthcare overall definitely intersecting. Dr. Hugh, Herr, professor from the MIT Media Lab, co-director of the K. Lisa Yang Center for Bionics at MIT, joining us from Cambridge.
Hey, when we come back, check on trading and stocks on the move. This on a day where stocks are in the red, 1.6% to the downside on the NASDAQ Composite.
You're listening to Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we are coming up on the last hour of trading, and we still are seeing stocks under pressure. We are just bouncing around, just off, though, our worst levels of the session. Still down about 1.6% on the NASDAQ 100. We were down as much as 2%. S&P 500, a decline of about 0.9%. And if you're interested, the Dow just down about 0.4 of 1 percentage point.
Taking a deeper dive into the S&P 500, the big laggard is information technology right now, down 1.8%. Industrials down 1.3%. Materials down 1%. Consumer staples are higher by 1%. Real estate in the green, but Carol, pretty much flat.
I'm Carol Massar, along with Tim Stenovec. Let's get to some stocks on the move. Bloomberg News cross-asset reporter Denitsa Tsekova, she is in the house. And you got to start with Nvidia.
Yeah, if you want to talk about reversals of fortunes, we have to start with Nvidia. The rally in Nvidia shares faded. Now it's down about 2%, but it fell as much as 3%. Initially, after we got the earnings, the stock climbed more than 5%. There were all those worries about AI spending, and it seems like this morning everyone was over it. But clearly, we're back, and investors are worried about AI spending. Nvidia had a very strong report. Of course, the sales were about 65 billion in the January quarter, 3 billion more than analysts were predicting. Everyone was excited. Jensen Huang addressed the AI bubble and said, this is something different. This is not what we're seeing from our vantage. But the fear is strong. Investors have expressed concern about the structure of all those mega deals, and there is 5 announcements a week we're getting out. Especially when it comes to Nvidia, there are investments in startups such as OpenAI, Anthropic, and the issue is whether the pacts are creating artificial demand for computers. And investors are worried. Nvidia currently is not projecting any sales from AI accelerators in China. So China has been one part of the report that is worrying investors. But yesterday was enough to ignore. Today, we're penalizing that.
It's such an interesting moment because for a big part of the morning until about 10 o'clock, the stock was surging. There was a rally happening, but then the real shift happened starting at 10, and we've seen the stock move lower since then.
Yeah, for sure.
There was no clear catalyst.
I think a lot of people are also worried about rate cuts. We saw the jobs report. It was a strong jobs report.
Agreed.
We see a Fed that split, so that's definitely weighing as well. But
Yeah. I mean, these riskier assets, right? In a higher rate environment, you look at these valuations differently. Hey, I do want to point out that Nvidia is off about almost 12% since October 29th. So technically, we've seen a correction in this name.
Yeah.
And I was just curious to see, I like doing the technicals, looking up RSI, Relative Strength Index, and that stock not yet moving towards maybe an oversold, but not really quite. Not. It's kind of in the middle between the red and green lines, red being overbought, green being oversold. So it's not quite there. And that's that valuation story. All right, let's get to one that is definitely an outperformer in today's trade. And it's not high tech.
It's not high tech. Yes, we have one stock that's definitely in the green today. Walmart shares rose as much as 7%. The world's biggest retailer raised its full year sales and profit outlook. The ticker, of course, is WMT. We're talking about Walmart, which sees net sales rising about 5% higher than previous projected. And this is the second time they increased their forecast. Obviously, everyone has been looking out for the consumers. We saw quite a few worrying earnings report, but Walmart is not amongst them. Of course, they're saying that they're seeing pressure in lower incomes, but compared to some of their competitors, we're not seeing that many worrisome results. That said, middle and higher income shoppers aren't pulling back. We know Walmart has been targeting them. They have like Chanel bags, and they have online derivative.
Wait, do they have real Chanel bags?
They have pre-owned. Yeah, that was a big push to reach those consumers.
I had no idea.
Are you getting?
You see?
Does that change your view, Carol Massar?
Yeah.
I don't have a view on Walmart. I just report on the company.
No, on Chanel bags. I don't know.
I think that's kind of interesting.
I mean, look, they're going for the higher end consumer. They're trying to bring it in.
Yeah.
They're big on e-commerce as well. That has been doing very well. And the stock is up 19%. So no matter what position it is on Chanel bags, they're doing well.
But I am right now Googling Walmart pre-owned Chanel.
Okay. Well, you do that. I'm going to
It's for work, research.
It's for research.
It is. Yeah. Can I just tell you, Walmart's up, 18% year to date? So it's been doing fairly well.
Well, let's go to another stock that's in the red today, and that would be Oracle. What's going on with Oracle today?
We're going back to the AI trade and the losers of that AI trade. And Oracle is a very interesting name. It's down 35% for its September high. Just today, it's down about 5%. The ticker, of course, is ORCL. And everyone has been looking at that name, and not just the stock. Everyone has been looking at the company CDS.
I'm so glad you're doing this.
This is so fascinating.
Yes.
So traders have piled into the company credit default swaps in recent months. So now we have about 5 billion of volume over the 7 weeks that just ended. This time last year, it was 200 million. So it's 25 times more. It's so interesting how this emerged as this barometer for AI credit health. We have an excellent story on the terminal, but Morgan Stanley is one of the companies who was actually worried about net adjusted debt of Oracle, and they're projecting it doubling to about 300 billion. And the hedge they recommended, 5-year CDS. on Oracle. So definitely this trade is circulating. Obviously data on this is coming a little bit slow, but you can imagine that it's a good barometer of investor being really, really worried. It's 3 times what it was just a couple of weeks back. So it's moving very fast.
All right, Denitsa, thank you so much. Stock Movers, check out those podcasts. 5-minute episodes of the biggest winners and losers. You can find it on Apple, Spotify, or anywhere you get your podcast. Hey, close coming your way. We continue on radio.